great pleasure to have each and every one of you joining us today. And just as a bit of reflection, if you feel that 2020 has left you exhausted and distressed, and you felt self-isolated, not wanting to face the news, and you felt that your goals were now out of reach, and your finances causing you more than a few pressure situations, which gave you more than a couple of extra wrinkles, and you think that things may get worse, I'd like to suggest that a new day awaits us. So be happy and appreciate what you have, and have a little love and caring, and a great deal of sense of humor. Let's take a leap forward and hopefully to improved health, happiness, and prosperity. What we're going to be doing today is a lifestyle financial planning update, which I'm going to give. My name is Andrew Bradley, and I'm delighted to welcome you on behalf of the Various Wealth, Chrome Wealth Associates. We're then going to be having a tax update, and then finally an investment update. I'll introduce Dieter Schultz, who will be doing the tax update, and Bernard van Wyk, who will be doing the investment update a little bit later. But let's go straight into the lifestyle financial planning update. Just as a reminder, the key objective of the Chrome Wealth Associates is to promote and enhance lifestyle financial planning for our client benefits. I think amongst the Chrome Associates, we have been at the forefront and pioneering the work in the space with all the new developments and client insights. This is something which we feel very strongly about, and we, over the many years, have not found a better and more appropriate way to engage with clients than lifestyle financial planning. It's often called by many different things, but the key aspect and issue here is that we're looking to try and pioneer it, to enhance it, to make it better. And our key focus is on taking care of and assisting our clients achieving their goals and aspirations over time. That's all that really matters to us. And so with that, our main focus area is in lifestyle financial planning and the clients we serve. And we try and do this as effectively as we possibly can. A lot of insights and research has gone into this, and we look at behavioral finance and many other aspects in this regard as to how we can do it more effectively. We look at also using technology to save costs and improve our service to our clients with better and more tax efficient investment outcomes. We are very clear about the fact that the better you invest, the better your lifestyle. And from that perspective, we look at everything from asset allocation to tax to costs to the most efficient way of doing an investment, looking at every option from the different investment vehicles that can assist our clients to achieve that. So it's all about optimizing client returns within those risk budgets. But being aware of what's happening in the environment and what's available to our clients is an issue that evolves and develops on an ongoing basis. And I think South Africa has gone through quite a number of changes of late within this environment that can have many different impacts. So looking at what those options and making sure our clients understand them as we guide them through those options is key. So I'm just going to focus for a couple of minutes now on some of those developments that are occurring within our environment that we as the associates think you should be aware of, because they can and potentially will make a significant impact to your financial planning. I think the first one, which has received a great deal of airtime, and many people see this as a focus on prescribed assets, and that's some changes to Regulation 28. So Regulation 28 which governs all investments in retirement funds, those retirement annuities, pension, and provident funds, were restricted to a very large extent in where and how they could invest in infrastructure. I think the country was in a significant hole as it was, but with the advent of COVID, it's got into an even bigger hole, and a very effective way out of that would be to invest into various infrastructure projects. And so the government have now made changes to Regulation 28 to allow for that. I know many people are of the opinion and are very concerned about the fact that this, is a prescribed asset, forcing you to invest into infrastructure. Now, we certainly have the opinion that it's not. But having said that, down the line, if retirement funds do not invest any of their funds into infrastructure, and the government is still trying to fund those infrastructure developments, it'll be very interesting to see what government does down the line. But certainly, right now, we see no need to be concerned or alarmed about that. In fact, it does bring some additional opportunities which could enhance the returns within retirement funds. But the retirement fund space has been having quite a few developments. The next one is the effective alignment of retirement funds. So to date, we've had retirement annuities, pension funds, provident funds with all their own little quirks. We've already seen some alignment, in terms of the tax deductibility. There used to be differences. Now they're pretty much all the same. So the next phase and evolution in that process has been to effectively get rid of a provident fund as we know it. Just as a reminder, a provident fund is where you invest and can only invest through a company, where a company sets up a provident fund, and at retirement you get a lump sum. You don't have to take an annuity or a pension. Effectively, as of the 1st of March this year, you can no longer invest into a new provident fund or set up or establish a new one. But if you did have a provident fund and you are older than 55, so on the right-hand side there you'll see, if you're older than 55, then there is no change for you. All your contributions prior to 1st of March this year, as well as after 1st of March, will continue to stay in a provident fund structure, and at retirement, you will be able to get your full amount as a lump sum if you so wish. But there's one little proviso there. You have to have remained within a member of that fund. So if you change companies and you move your money to another provident fund, then that benefit will not be there for you. If you move your money to a preservation fund, provident preservation fund, that obviously will then preserve that in that structure as well. But if you are younger than 55, what they've said is all your money that was in the provident fund to the 1st of March will remain as such. And when you get to retirement, whatever that has grown to, you will be entitled to take that as a lump sum. But any contributions after that, will effectively be in the same parameters as a pension fund, where you will only be able to take 1/3 as a lump sum, and the 2/3 remaining, you are forced to buy a pension or an annuity. So the key thing there is the alignment. There's another whole conversation as to whether one should be taking out the full lump sum. In many instances, even if you are in a provident fund, from a tax planning and estate planning point of view, it may well be a very good idea not to take out the full lump sum. But what the government are here trying to do is to prevent people from squandering their money at retirement and then becoming a burden on the state. I think it's important to note that this is just the next phase in this evolution, and further changes are being looked at to further simplify as well as create some additional flexibility for members. So we look forward to some further developments in that regard. Then the issue of over-contributing to a retirement fund. So, in terms of the allowable contribution of 27.5% of your taxable income, subject to a maximum of 350,000, Is it a good idea to over-contribute? I'm generally of the opinion that it isn't a good idea if you are young and have to wait a long time, unless you get the tax deduction in the next year, which is fine. However, once you get to age 55 and you are eligible to convert your retirement fund into a living annuity or have it paid out to you, there can be significant benefits to over-contributing. So one of the advantages of doing that is that if you want to move assets that would effectively be part of your estate to be excluded from your estate for estate duty purposes, you can move that into a retirement fund, retire immediately, and then move that money into a living annuity. But the government have now clarified a couple of aspects there. So where to date you have over-contribute and that contribution has been disallowed in the year, it's carried forward to the next year. And this continues until it's been fully applied. But should death occur before this happens, then the government had said, and the tax laws provided, that the full amount that hasn't been written off as a tax deduction is then added to your estate as deemed property, and you will then pay estate duty on that. But they've now clarified and said that will only be applicable if the lump sum decides to take out the cash. If the beneficiary decides to take out a cash lump sum of the either retirement fund or the living annuity. If not, so you don't elect to take out the cash as a lump sum as a beneficiary, and you continue with the annuity as a living annuity, then it is not included in the deceased estates, and it'll have no impact on their estate duty calculations whatsoever. So a significant tax and estate planning tool that can be used very, very cleverly, and I'd certainly recommend that as part of your planning, you definitely have a look at that. So as you can see, there's been a number of developments in this area, and another one is in the area of living annuity. So that's where you've been in a retirement fund. You retire. Once you have retired, you put your money in a living annuity. Previously, you would nominate another beneficiary, and there was some uncertainty as whether you could nominate a trust as a beneficiary on a living annuity. Now, there's clarity that a living annuitant can nominate a trust as the beneficiary of a living annuity. So a living annuitant can nominate a trust. And there are numerous scenarios where this is a good idea. So what happens if some of the beneficiaries may be over 18, some might be under 18, and you wouldn't want to leave assets, and if you leave assets to children under the age of 18, there are a whole lot of other dynamics. What happens if the beneficiary that you want to nominate could perhaps have Alzheimer's or some other health challenge? Or there might be some other issues in terms of marriage and divorce and other dynamics. It might be, in those circumstances, a very good idea to nominate the trust as a beneficiary on the living annuity. But there are a couple of implications of this. The first one, the income in the trust is taxed at the full tax rate of the trust, which is effectively 45%. So it will, in most instances, if not all, mean that more tax is paid. However, SARS have said, and the tax laws now provide, that this can be mitigated. So as long as the trust then says they're receiving this on behalf of the beneficiaries and they're going to pay out to the beneficiaries, they can then become almost like an employer, deduct the pay as you earn from each of the beneficiaries, and then get a reduced reduced tax paid by the trust and the beneficiary. So there are ways of mitigating that. And then secondly, what will apply is if the trust dissolves, so the money is being paid into the trust on a monthly basis, and for various reasons, whatever the trustee may provide for, the trust may eventually dissolve. The balance in the living annuity, whatever is there, can be paid as a lump sum to the trust in anticipation of its termination, and the applicable retirement fund tax lump sum will be paid in that instance on that lump sum. So whatever the sliding scale, first 500,000, etc., tax-free, that will be a further benefit that will be provided on that lump sum when it is paid to the trust. And then another area which always receives a lot of focus and attention is on immigration. And again, Dieter will take you through how effectively the concept of immigration very soon will not exist, and that's why I put in there when you become a non-tax resident. So what was introduced last year is that if you want to leave the country, no longer become a tax resident of South Africa, and you are under the age of 55, you want to now access the money in your retirement fund. Before you can access that, you need to remain a non-tax resident for at least 3 consecutive years before you can access your money. So you happen to be 40 years old, money in your retirement fund, you leave the country, you want access to that money. You have to be there for 3 years before you can access it. And when you take it out, it's taxed at your withdrawal tax rates. But if you decide you've left the country, but you want to leave your retirement fund assets in place until retirement, you've now left the country, you're over the age of 55, then there's some fairly interesting tax developments that are happening there, because now you're living in another country, you're a tax resident there, you're no longer a South African taxpayer. So whatever the tax laws of that country are will now be applicable to retirement fund assets. So SARS have realized that they will then lose out on that. So they've said going forward, they will apply a tax rate on the day that you leave. So if you age now 40, whatever money you had, let's assume as 100,000 Rand in your retirement fund, they'll say, here's 100,000. What would the tax be on the withdrawal benefit of that? They will note that 100,000 might grow to 5 million Rand when you get to retirement. They will determine the amount of tax, they've already determined that amount of tax. When that's paid out to you, they will deduct their tax. In addition to that, depending on the country that you're now living in and the tax rate there on retirement fund lump sums, you may be taxed again. So SARS will ensure that they collect their money in this regard. So as you can see, as things evolve, as people become more global citizens, our retirement funds and how we make use of them, there are many, many different dynamics. And it's critical that we remain up to speed on these. It's critical that each of us are aware of them, because they can and will have a potential impact on what we do and what our tax planning will be. Thank you very much. Cheerio.